Okay, so we'll start now. And welcome back to the next session. And post-lunch sessions are normally challenging. So I hope our speaker will keep you awake. So the next session is a presentation again. And the topics for this presentation is a regulatory perspective on risk management. And for this presentation, we have invited our regulator, Kiran Pandit sir, from Nepalese Bank. I think he's pretty familiar, doesn't require much introduction. So, however, he's the director, Bank and Financial Institutions Regulation Department of Nepal Rashtra Bank here in Kathmandu. And so he's already here. Let's give a big hands to welcome Kiran sir. Sorry.
Thank you. Thank you, Donzer. Good afternoon. Namaste, everyone. Today, you are like a big gathering. So it's you conference. Today, I'll be talking about risk management from regulators' perspective. धेरैजनालाई त यो भनौँ न हाम्रो रेगुलेटर्सले जारी गरेको सर्कुलर डिरेक्टिभ्सहरुमा हाम्रो आशय बुझि नै सक्नु भएको छ तैपनि let's talk about from regulators perspective. So I'll be talking about mainly risk-based supervision. Then I'll go with contemporary issues, and then I'll talk about regulators' expectations. So I'll start with some overview. For this 1.5 hour or just 1 hour, I have set our objective to have an overview and discuss with the stakeholders on regulatory perspective and expectations. So today I'll be sharing what is our perspective, what we want from the risk management function of the BFIs. Is it correct if I say that we need to do financial intermediation without taking risk? Will it be correct to say that? Yes, no? No. So is it possible to have a banking function without taking risk? Yes. It's the right answer is no. So regulatorले पनि के बुझ्छ भन्दा what regulator has accepted is we have announced it in our guideline also. Taking risk is an integral part. It is the basic phenomena, it is the basic fundamental thing of financial intermediation. So whenever we talk about banking business or financial intermediation, risks come over there. We cannot exit or we cannot just close our eyes and say that there is no risk. So failure to adequately assess and manage risks may lead to losses and endangering the soundness of individual financial institutions and affecting the stability of the overall financial system. So what we have emphasized is, it is not only for the micro level, entity level perspective. Even it is important for the systemic approach also. We can be talking about micro perspective or macro perspective. For both sense, we have to talk about risk. So there is no way out, there is no shortcuts. Why? Because there are few basic fundamental things. Some time we get carried away. Not only the regulator, but the wider segment of the stakeholders also get carried away. And they comment, very light comment like, BFIs are making profit. So is it a right statement to say that financial intermediation should happen on free of cost? So will the system sustain? No. So the very basic thing is BFIs are profit-making entity. And we regulator know it. We accept it. But sometimes we get carried away. Sometimes we get carried away with some online media or some light comments made by anyone in the society. That profit, they look after the absolute amount, and then they comment like banks are making huge profit. But as a regulator, we say that they are there to do financial intermediation, and for this they have to earn the profit. They are profit-making entity. So with this approach, then comes a risk-return trade-off. Can you earn profit without taking risk? So basic fundamental thing is the risk-return trade-off. So financial intermediation or the banking business is not possible without this trade-off. So shall we take all risk then? So shall we compete for the profit? So regulator is saying that you are for profit, so shall we rush for the profit and shall we just do the competition for the profit? No. So there are a few theories which say that we should not be taking those risks which are not compensated by the return. That is not the wise decision. You are not taking right decision. So we'll be talking about financial stability. Financial intermediation is there, and I said profit is needed for sustainability also, for the continuity also, and the basic fundamental thing is the risk-return trade-off. So we need this for financial stability too, and in both term, micro as well as macro. If an individual entity can manage their risk, and then they earn a sustainable profit, and they do a sustainable business, then from micro perspective, the individual bank or financial institution is maintaining some stability. And if all banks are doing same thing, then they are contributing for the total financial system stability. The other thing, why we need this fundamental discussions on risk management is for the credibility, for the trust. Because the whole thing, the whole entire ecosystem of financial intermediation depends on the trust. Isn't it so? Yes. So if your depositor does not trust you, if your depositor wants to take your money back, and everyone is following the same intention, that they don't trust the system and they want to take their money to their home, they want to keep it themselves, then intermediation is possible? You think so? No. So BFIs are required to manage their risk wisely, prudently, to win the trust also. The other thing is, as I was already mentioning, it is for the ongoing, it is for the continuous, it is for the perpetuity. We cannot imagine that this bank or this financial institution will close after 20 years, and before that, this bank will earn this and that amount, and their life is just for 20 years. Can we imagine that? No. So this is for the going concern. This is for the perpetuity. And now, why risk-based supervision? What is this risk-based supervision? Why this phenomena was started? Not only in Nepal, but rest of the world also. Why? So for this, let's discuss some points. We want to focus on the risk management to assure the stability. Why we just don't want to focus on compliance? Why we want to focus on stability? Why we want to assure the stability? Because we want to make our BFIs more forward-looking. We believe that if we talk about risk management, then it is more forward-looking. If I say, or if I am focused, if a regulator is focused only on compliance, then I will be just finding the non-compliance aspects. I'll be ticking all the compliance checklist, and then I'll come up with some list where I have noticed the non-compliances, and then BFIs will correct those non-compliances for the next cycle, and again the same thing will happen, and the regulator will again identify the non-compliances. But here, when we talk about risk management, it is more forward-looking. We want these non-compliances not to happen in the future. We want BFIs to have such system which will stop such non-compliances to happen in future again. So not only saying that risk function is there and risk officers are there, you have a sound risk management. We don't believe that. We want you to identify, measure, monitor, and control the risk. You should have these processes. You should have this management system. So NRB felt that now it is the right time to talk about identification, measure, monitor, and control the risks, whatever the material risks that are inherent in your business. the same thing happened, the more realization happened after the crisis of 2007 and 8 in the entire world. So in the same line, we also issued risk management guideline in 2010, and then we started on-site inspection with the perspective of risk management. We started to ask about your risk management functions from 2014. And then we changed, or we updated our risk management guideline in 2018. So it is a continuous process. And it was needed for, my third point is on supervisory resource allocation, because if most of the banks are in normal regime, or you can say normal supervisory regime, then my supervisory resource can be allocated to the high risk areas. This is a basic fundamental thing. So once the system is growing and complexity is increasing, same thing happened in the Nepalese financial system also. Banks were increasing, or by the word bank, I'm mentioning all BFIs. So banks were increasing, products were increasing, somehow innovations were also there. So complexity was growing. So that's why we moved toward risk-based supervision, so that we can have some focus on exceptional cases, focus on high-risk areas. So this was our perspective. And the broad thing, if I mention it in more technical term, then it is about focusing on pillar 2. I hope you are clear on pillar 2, because mostly whenever we talk about regulatory requirements, we limit ourselves in the pillar 1 of the Basel principles. Basel occurred. I hope all of us are quite clear on 3 pillars of Basel. So Basel 1 is about regulatory capital. Pillar 1 is about regulatory capital. Pillar 2 is about your assessment, is about ICAP, is about your additional things beyond regulatory requirement. And it is about the supervisory review process. So what extra risk you are looking after? So this is what we felt, and then we moved toward risk-based supervision. And which framework? Let's quickly go through the framework of risk-based supervision, followed by NRB. First, what we do is we assess the risk. So it is about the quantity of risk. It is the gross risk. It's the quantity of risk that you are taking. Then we add how you are managing that risk, because we have already set the fundamental thing that without taking risk, financial intermediation is not possible. So you are taking risk. Now we'll ask you, what are the risk management processes that you are following? So we assess the quality of that risk management process. First, we check what risk you are taking. Then we are assessing how you are managing it. Then we'll do the netting. Okay, this is the gross risk, and this is your management, quality of your management process. Then we come up with that aggregate risk, which is some sort of netting. And then we categorize it in 3 scale: high, moderate, and low. Then we check the direction of risk, where this risk will head for the next 12 months, for the next year, whether it is growing or decreasing or stable. So we'll see from the trend, from the numbers, from the questionnaires, from the meetings, from the policies, from the approaches. Then we try to assess that, and we finally come up with the supervisory regime, in which regime particular bank falls under. So should it be in normal regime, or should it be in close monitor, or should it be in supervisory action? So this is the basic framework of risk-based supervision, followed by regulator. So we do it for credit risk, market risk, liquidity, operation risk, and all. And then we, as a supervisor or as a regulator, we decide about the supervisory regime for a bank. I will not go through these details, but just quickly surfing it. What were the major shift with all these framework and with all these new words and new terminologies and focus on pillar 2? What we are trying to emphasize is, as I have already mentioned, that we are trying to move from compliance only regime to risk management regime. So in the earlier regime, we used to focus on regulatory requirements only. So these were the non-compliances, these were the missed by the bank. But now what we want to focus on is your governance structure, quality of your policies, quality of your assessments. And previously, we used to focus on whether you have done, for example, whether you have done provisioning or not, whether you have followed that circular number 2 or not. But now we will be checking whether you are having that provisioning adequately and you are developing some methodology or not, whether the lapses will happen in the next cycle or not, whether you are having some forward-looking approach or not, whether you are having some capital buffers or not. So these are our measures saved. In terms of scope, what we have done in the past is we used to focus on camel rating. I hope you are quite aware about that, camel's rating. And recently, after this risk-based supervision approaches, we have developed risk profiles of the banks also, beyond camel's rating. So we have camel's rating as well as risk profiles of individual bank. So this is the addition. And for the methodology, earlier, more focus was on something like transaction testing. More focus was on review from the perspective of compliance. But for now, we want to have some interaction with board, we want to have interaction with senior management, we want to go through your policies, adequacy of the policies, quality of the policies. So this is our approach. We want to know how you are identifying, measuring, monitoring your risks, how you are trying to manage your risks, whether you identify that or not. Though, plain and simple language, we say that it is risk-return trade-off, and we want to know whether you are just following the whim, whether you are just following the course of the wind, or you have your own course, and you know it, and you understand it. You are knowingly, you are understanding it, and you are knowingly doing it, whether it is happening or not. So we want to check this with your board, we want to check this with your senior management, we want to check this with your risk function and relationship managers and all. So this is our perspective. We want to know how you are managing your risk. As I have already said, we want to focus our more time, more resources on high risk areas. To continue with this, traditional approach of supervision was more like post-fact analysis of banks' performance in the last year. If I'm seeing more young crowd, maybe most of you don't know our old version of our reports, prepared in some 2065, 66. Those old reports were like, if you want to review them, you ask your office, and you can go through those reports. Those were like morely, those were like financial analysis of your statement submitted to you. We did 3-year analysis. We analyzed your financial statement and we submitted to the bank with all our findings. So it was like a post-fact review with all the non-compliances noted over there, more focused on the numbers, which was presented to the bank management itself. And later we realized that why we need to do that, because you are fully aware about your numbers. You know the trend. You know how deposit is growing and how credit is growing in your bank. So let's talk about something else. So we changed our perspective and we started RBS approach of supervision, which is more forward-looking and risk-focused. Now, we wanted to focus more on risk areas. We wanted to focus more on your control aspect. How is your internal control environment? How you are managing your risk inherent in the business. I've already mentioned this, that earlier we used to focus on camels only, but now we prepare the risk profiles of credit risk, liquidity risk, market risk, interest rate risk, foreign exchange risk, and operational risk. And then we recommend supervisory regime as a supervisor to the NRB board, that we should keep this bank to this regime, and we need to focus on this aspect. Maybe it can be IT or credit or liquidity for the next cycle. Why RBS? So why we are focusing on these things? Why we want to look after your managerial aspect from the risk perspective is to treat the very basic thing, which I repeat most of the time, is to treat the root cause rather than the symptoms. If I just note down the compliance, if I just note down the lapses, that will be the correction of the symptoms only. You'll say that if the very quite common example, let's take one example. If I say that insurance of this and that client is expired, and then you'll reply me that, okay, I have renewed it. Should I be satisfied with that answer? Now, we'll say that let's develop a system which will make you aware about the expiring insurance policies. You will know it earlier rather than a supervisor coming to your office and noticing that your particular file's insurance is expired. So let's develop some system. So this is just an example. It can be for fraudulent activities, it can be for compromise in underwriting standards, or it can be mistakes in your offer letters that you provide to the clients, or the errors in your system. So we want to correct the root cause. What is giving that chance to have that non-compliance? What is the compromise in your internal control environment by which that non-compliance is happening? So corrective measures before it's too late, so that in future it won't happen again. Sometimes we hear the news that, okay, this and that happened, and fraudulent activities happen. It was the problem in reconciliation, or it was the problem in valuation, or it was the problem in field study, or it was the problem in diary note, or your whatever field study reports. So once we notice that, then we want to ask the BFIs that which system you developed, where you intervene, so that it won't happen in future again. Where are that separation of duties or segregation of duties? Where is that maker-checker thing? So that we can work on the root cause rather than just get limited to the symptoms. So focus is on the processes and policies of the bank. We want to assess the quality of the policies. We want to assess the quality of the processes. To be more forward-looking, increasing complexity and supervisory resources, because I have already mentioned it that complexity is growing, and the recent, if you see the recent changes in the system in these 2 years, we have moved toward the digital world. If there was not a pandemic, then it could have taken more than a decade to have such developments. But we did this in 2 years. It was a great achievement. But did we compromise something? Did we build up some risk? Did we give some chance for the cyber security or some fraudulent activities? So let's focus on that area. So just an example. Or recently, maybe the liquidity risk, the supervisory resources can be there, or maybe the subprime lending that might have happened in last 2 or 3 years. Let's focus our supervisory resources on that aspect. So these are just an example that how can we channel our supervisory resources to the high risk areas if we follow such approaches. We want more resilient banks, more stable system. These are the basic points. Enable banks to assess their risk in real time. So again, pillar 2, we want to focus more on your approaches, your internal assessments, your processes, your plannings. So what happens if only compliance, if regulator is much more oriented toward compliance? So I usually get such questions. Can we do it? Sir, this is the provision, this is the statement, this is the article written in your circular, so can we do it? And whenever I hear such question, I keep on asking my colleagues or the colleagues from the BFIs, shall we do it? You ask, shall we do it? Because the questions are different. Can we do it or shall we do it? Can we do it is a very limited thing. Because you need to read the spirit, you need to read between the lines of our circular. That is what I answer. And you discuss in your own office whether your management decides, shall we do it or not. The other thing, in the same way, can it be done in this way or that way? Because people keep on asking me that, sir, it is not written in the circular. You have written this much, but you have not written this in the circular. So can we do it in this way? Can we tweak in that way? Can we interpret in that way? Can we have this document? For example, the concessional loan, Sauliyat Purna Karza, the preamble of that, that policy says that that is for the entrepreneurship development, that is for the employment, that is for the production. And only those are eligible who take loan after the issuance of this provision. This is the circular. This is the provision. But what we try to interpret is, okay, it says that the loan taken after this policy is not eligible, only eligible. So let's provide some new loan. We forgot the essence of the preamble. We forgot the essence of new production, new entrepreneur, new employment. We just read that, okay, the new loan is eligible. So this is how we interpret an example. So I used to get such question, can it be done in this way or that way? So why not to ask, like, are we being prudent doing it in this or that way? So why you not decide, or why you not discuss in your board or in your senior management meeting that should it be done in this way? Are we being prudent if we do this? If we interpret the policy like this? The other way around. Same thing, it should be spelled out in the regulator circular. Most of the time we encounter that, you saw NRB likh dios. So still we are in that compliance only regime. Though regulator is saying it for a decade, since 2010, it is already 22. So it's more than a decade. So we are saying that let's move toward forward-looking approaches. Let's move toward prudent approaches. Let's have your pillar 2 approaches. But still, we are so prone to interpret the circulars in those black and white numbers only, in those statements, in those words only. We don't read between the lines. And somehow, when I discuss with my friends unofficially, then they say that the spirit is quite clear, but we want to know. So this is what we used to hear. So because it is already there, we know it, but still we want to interpret that it should be spelled out. For example, what NRB said is, loan needs to be repriced with the base rate, change in the base rate. And we mentioned that you can reprice the loan, you can increase the interest rate when base rate increases. And we said that there is no restriction to reduce the rate. And we got the question that, so you have not said that if base rate decrease, I am forced to decrease the rate. So why not to keep the highest rate, higher rate? Because you have said that the loan needs to be increased, the interest rate needs to be increased only when the base rate increases. You have not said I have to decrease it. And then I ask, you have not got the spirit of that? You didn't get that, really? So we want to see these things. So or should it be our managerial decision, or should it be in our policy? Is it prudent? Shall we do it? So these questions, we want to move toward those second questions rather than those first questions. To continue with this, in our 2018 risk management guideline, I don't want to go through the details, but I just want to give you the glimpse that we have talked about dimensions of risk management as well as risk management framework. So in dimensions, we have talked about risk culture, risk strategy and appetite, risk governance and organization, as well as risk assessment and treatment. So this is in the dimensions of risk management. We have spelled out our norms, our spirits. Risk management framework, there we have discussed about active board and senior management oversight, as well as risk management departments and various committees. What are the basic norms, what we expect, these are spelled out, policies and procedures, appropriate MIS, comprehensive internal control and limits. So this is what in our risk management guidelines. So broadly, we have provided a guideline to have a complete risk management process, to develop a complete risk culture in the BFIs. Now let's go to the contemporary issues. From the risk aspect, I won't go through other thing. The very basic thing is whenever we talk about the risk in financial intermediaries, we encounter that these are credit risk, liquidity risk, operation risk, interest rate risk, market risk, AML, CFT, and strategic risk. These are the quite basic thing. And most of you are from credit risk, and some are from risk units. So what are the concerns in today? If you ask me what can be the today's concern of the regulator or the supervisor, so for now, for the current contemporary issues, we are concerned to our governance. We are concerned to our professionalism of the board and senior management. Because of the very basic thing, the very first point that I've showed you. Of course, we understand it's a profit-making business, but shall we focus on that only? Compromising the governance, compromising the professionalism, compromising the prudence approaches. So this can be today's concern. because we have seen challenges are being built up, either in terms of liquidity or in terms of credit risk, because we are being very short-sighted, we are being very myopic, much more toward profit. Because all the grievances that come to us, all the financial conduct feedback that come to us, and all the findings that our supervision departments are listing out, we are worried whether unhealthy practices are happening in the industry or not. We have seen the cases, and we personally feel that, okay, it should not have happened. Because maybe we are being more oriented toward profit. That is where the regulator is worried about for now. The other thing is non-compliance and negligence. Though I said that we need to move forward from this compliance-only regime, we are noticing that a lot of non-compliances and negligences are happening. I don't know whether it is deliberate or ignorance or what is the intention behind it. I leave this to yourselves. But we are noticing a lot of non-compliances. And the other thing is onboarding and relationship management. I just wrote that phrase because what we have seen the tendency in the market, and it is quite open, it is not hidden fact, that when we have some surplus, when we are chasing for the business, then we do subprime lending. It happens throughout the world. When we have surplus liquidity, we lend to any project, anyone. And I keep on asking, do you have customer acceptance policy? Do you have something on onboarding the client? Do you say yes or no on the basis of business proposal? Do you have a list of files or list of clients whom you have denied? And usually I get answer no. Sir, we don't have such practice. We do credit assessment only for those whom we lend. We keep records of only them. So, are we compromising on onboarding thing? Are we having that perspective? So that is one thing. And the other thing is relationship management. Are we managing our relations in a prudent manner or very healthily? Chasing the profit or maybe going after the profit, we are compromising on that standard only. That standard also. The other thing is financial consumer protection. With all these, what I was trying to mention is regarding our feedback from the financial consumers regarding fees and rates. We are so prone to misinterpret or misunderstand the circular's provisions. And a lot of non-compliances were being noted. Same thing. The other one is quality credit creation, including concessional loans. Now, what happened in these 2 or 3 years? Because if you see the last decade, credit growth is happening so rapidly. And most of the experts, most of the economists claim that it is not being reflected in the economic growth side. Employment is not increasing, production is not increasing, and where your credits are growing, where the private sector credits are being channelized. So from the macro perspective also, what happened to the quality credit creation? Are we focused on numbers only? Or are we focusing on quality credit creation? The other one is repayment and recovery. This is a big challenge because of the pandemic. Today's concern is on repayment and recovery also. Most of the feedback that we receive from the borrowers are they are having some stress on repayment, they are having some stress on collection, so we are having problem on the repayment. We cannot pay to the bank on time. So they are still asking for deferrals or moratoria or something like that, which we used in the pandemic period. But we have already unwinded those provisions, but still the problem is on repayment and recovery. So somehow credit risk is being built up over there. Enforcement of supervisory actions, the other thing. The concern can be on enforcement of supervisory action, the delayed or different reasons. The other is on merger and acquisition. Our focus is still on merger and acquisition. Regulator is still on consolidation side. The NRB is still encouraging merger and acquisition. So whether we are having that synergy thing or not, whether we are building some HR risks or not, whether we are having some business quality aspect risk or not, or we are having some good consolidation. That is yet to be seen. The studies will be made in the future, maybe. So, but our priority is on merger and acquisition. That is another issue, contemporary issue. The other one is cybersecurity, which I have mentioned in my earlier slide also. We have gone through digitalization very rapidly. Those services which we used to do only face-to-face, like in those days when I have to go for e-banking password or user, then bankers used to ask me for a certain fee, and I have to fill up the form, and I have to get that code, and I have to use that. But now I can generate it in my mobile. So we have done that development. But did we compromise something or not? Are we investing a huge amount on cybersecurity aspect or not? So IT risk is also growingly seen as very alarming thing throughout the world. So same thing can be the case in Nepal also. To focus on post-COVID risk, as I have already said, mainly it is credit risk. Because I feel that we are yet to see the surge in non-performing assets. So far, what happened is we allowed restructuring and rescheduling, we allowed deferrals, but now what will happen from the next cycle? So chance is there that possible growth can be in non-performing assets. A restructured portfolio can grow, and foreclosures may happen. Because in those close lockdown period ma ta हामीले रोक्यौं नि. In those lockdown days, we stopped the foreclosures. We restricted the recovery through the foreclosures. But I think that it will grow in coming days. Because we were deferring the installments, we were waiting for the time so that they can have some revival. But let's see how it goes. I personally feel that maybe the cases of foreclosure will increase in the days to come. So this is about the credit risk, and the other is dependency on regulatory forbearance. As I have already mentioned, a lot of people are asking for another cycle of forbearance, another cycle of relaxations, another cycle of deferrals. So somehow the word can be a bit harsh, but moral hazard is there somehow. Maybe in borrower side, or maybe in BFIs also, if we get this forbearance, or if we can buy this time, this cycle, then we can book this and that profit, or we can clean up our balance sheet. So maybe. The other one is liquidity. Dependency on refinance is a huge dependency on refinance as well as on SLF. We are seeing it. So stress is being built up on NLA, as well as there is huge non-compliance on CD ratio, but it is yet to be checked. Regulator has given a deadline where BFIs are required to maintain a CD ratio, a given CD ratio, but stress is there. And the other one is stress on capital also. Personally, I'm seeing huge stress on capital adequacy. Forget about the buffers, forget about the ICAP, even the regulatory minimum standards, there is a stress on capital also. So how banks are going to manage it, that is yet to be seen. The other one is rates and pricing. Rates are going up. Still, there is a pressure for upward revision. Rates are going up, and economists as well as other experts are saying that rates will go up because of the basic thing like demand and supply, the rates will go up. So by this, what effect will be on the borrowers or on the industries or in the larger macroeconomy, that is yet to be seen. I have already used that moral hazard. I don't want to repeat that. And other is remote operations, that is on cybersecurity, because we opened up all those businesses which were not used to be done remotely. Those were restricted, but now we are using VPN, whether those were licensed or not, whether that is completely safe or not, but in the name of VPN or in some other arrangements, we have started remote operations also. So that can also bring risk in the BFIs. Recent regulatory actions, we all know it. Need not to go through the details. We increased the risk weights with the view that the risks are being built up in those sectors. So we revised risk weights so that BFIs will allocate more capital on those sectors. We increased the general loan loss provision by 30% last year. And we also mandated that loan loss provision should happen before you publish your financial statements. So that the enforcement will happen more closely. The other one is the valuer's contract, because we know that most of the loans, or almost all of the loans, are collateralized loans. We believe more on collateral, and I won't say it is wrong, because of course that is a safety net for you. But regulator has come up with a norm with the valuer's contract. And the other one is COVID response. We all know it. The other one is as well on loan against shares. We have come up with that idea also, because for the speculating business or for the trading business, only through the shares, we don't want BFIs to build high risk on those sectors, so we limited that. The other one is financial consumer protection. If you see last 3-4 years, NRB has worked a lot on financial consumer protection. We have issued a lot of circulars on rates, fees, and foreclosures. With all these contemporary issues, to think more on risk aspects, to think more on forward looking, I'll go through some supervisory observations too, to link with how we are managing our risk, so that we can see how weak or how strong is our system, because it does not apply to all bank, and it doesn't mean that it is imaginary. It is the supervisory finding. Now, one is weak board oversight. We have clearly said in our annual bank supervision report, which is publicly available in our website also. Most of the boards were found occupied with business, with operational issues. So that we said that they are having inadequate and inefficient, ineffective control functions. Board oversight is quite weak, and whenever we talk about pillar 2, the importance is quite much more given to the board oversight and senior management, but we see that in reality they are much more focused on business. Other finding is ineffective internal control. We are still seeing stale policies in few banks. We see errors in regulatory reporting. It's a big issue. Whenever I discuss with my off-site colleagues, they say that quality reporting is a big issue for them. We are investing huge on supervisory investment information system, SIS. So once it is implemented, then we may correct it. But still, regulatory reporting, either in terms of risk weight or recognition of asset quality or simple the numbers, we find a lot of errors. The other is weak audit committee. They are there for only regulatory norms. They are discussing on the basic required phenomena only. Lack of audit of first and second line of defense. We are still seeing that audit of risk management function or audit of compliance. This is lacking. The other thing is non-existence of customer acceptance policy, which I already mentioned, and what is the risk under that. The other is weak assessment. Credit appraisals are still, there is a room for development, and there is always a room for development, and it's quite easy for regulators to say that it is inadequate. But to be very honest, we are seeing very basic assessments. Just very basic assessment where you know the answer and you're trying to justify the answer. So weak assessments are there, because when we have this lack of customer acceptance policy and weak assessments and weak strategy of pricing, then of course we are building up the huge credit risk. You can relate it in that way, because pricing in the recent days also we are seeing pricing is being made quite in ad hoc manner. Sometimes we are increasing premium by 2 or 3 folds. Sometimes we are increasing or decreasing, we are giving discount, whatever. Are they backed up with adequate analysis? When I say that, when I call my borrower and say that your premium, I have doubled your premium, does it mean that credit risk has doubled to that particular individual? Have we analyzed in that way? And regulator came up saying that, okay, you cannot change the premium. So that is also, personally, I feel we have to have risk-based pricing. So where is that analysis? That is still a weak aspect. Other one is inadequate monitoring or maintenance, like relationship officers or the person who is authorized for the maintenance of that particular relation. He or she doesn't know the business has already closed or the owner has already sold the SUP or whatever. And the account movement, how the funds are being moved or being used by the borrower. Are the funds being used in intended purpose or not? So reviews and renewals are a bit weak, what we find in our supervision. The other one is imprudent and unhealthy recovery. Not only to the borrower, we have seen that pressure on staff also. We get to hear the statements like I have used my total entire human resources for the recovery. So is it a right statement? Is it a good statement? So can you deploy all of your employees for the recovery? I don't think so. So it is not a right practice. You are giving pressure to the borrower as well as to the staff. So some more, that is ineffective ALCO. As I've said, that pricing analysis are very limited. Because just by plotting the rates of all the financial institutions and going through the norm or following the wave is not the middle office job, is not the risk analysis, that is not the market risk analysis. So FS risks are not properly analyzed. Similarly, ineffective and inefficient MIS. By MIS, sometimes we get confused with our core banking system, but here I'm not saying we are talking about core banking system. It is about the MIS. It is about the information system that your decision maker is using. The other one is repeat observations. That is again to the compliance only regime, because we correct the non-compliance of a particular file, a particular case, a particular transaction. But we forget that I have to change my policy or procedure so that the same thing won't happen in future. The other thing is error reporting mechanism, because it is a big thing for operational risk that needs to be analyzed through the losses that you made from the errors. That needs to be reported, that needs to be recorded, that needs to be lodged somewhere so that you can have such assessments. The other one is BCP and drills, business continuity plans and drills. Sometimes we feel that this particular BCP and drills are quite theoretical. But given the mega earthquake and the pandemic now, most of the BFIs must have realized that it is not imaginary and it is not theoretical. Because I remember in those days, in 2067 or 2068 or in 2014, whenever we talk about BCP and BFIs used to ask us, sir, why you are asking such imaginary hypothetical cases? Whenever we ask them, like, if there is something and you have to run your business with just 10% of your staff, do you have any plan for that? And without seeing pandemic, that was quite hypothetical also, I agree that. But imagination was needed, but the forecast was needed. And now we have already faced such situation where we could not open office physically. Yet, we are yet to see the drills, the proper BCP, the complete BCP for the operation risk, for the ongoing concern thing. The other one is weak grievance redressal. Though we have said that, though regulator has said that the conduct thing should be strong, the financial consumer protection should be emphasized, and you should have some grievance handling processes. We are finding this particular aspect very weak. The other one is poor HR practices and investments. Most of the grievances, though I want to mention one thing, though our financial consumer protection or grievance handling thing is for financial consumer, we get huge number of complaints from HR also. And some complaints make me feel that how they are handling their people. So, other one, because your organization is being run by these people. Whatever we say, whatever I have presented so far, this needs to be done by the people. This needs to be done by your HR. So we want to have some healthy investments on HR, though regulator has mandated 3% on human resource development, but we are yet to see healthy practices as per the given risk category of the customers. That is still lacking, and other one is capacity development is still lacking, though it is for total HR given the specialized function AML CFT. Now, I'll focus more on regulatory expectation. This is only for what we are seeing in the industry, what we are seeing in the system, how you are managing your risk, what are the things that we have noticed. To go through the regulatory expectations from risk management, we want independent risk management. If some of you are working on credit risk or market risk or liquidity risk, we want your job to be independent so that you can comment, so that you can ask, so that you can have access to the information, to the reporting lines, so that you can comment freely, so that you can assess your risks freely. You should not be having some targets, you should not be having some approving authorities. Because I've seen that a few friends who are working in risk or in audit, either it is first line, second line of defense, or even third line of defense. So second line of defense and third line of defense are also having some business targets. And usually I get answers, sir, it is not deposit, it is not credit, it is only credit card. So should you be having some credit card targets? You should not be. The other one is we want risk management to have access to the board. That's why we have imagined a risk management committee, a board level committee, so that all the control functions will report to that board level committee, and only board will merge the business function and control function. That will be merged in the board only, so that it works quite independently. It is separate from the business function. You are not having some business targets. In those earlier days, when our banks were quite simple, very basic bankings were done, we're happy to see that chief credit risk officer is having some credit limits. That was quite okay in those days. We're happy that, okay, there is at least he is talking about risk or she is talking about risk. But now we don't want to have such title with credit approving authority, discretion. We want it to be very separate from the business function. The other one is reporting and analysis. Your reporting, I imagine most of you are from risk function, so your reporting should be to the proper channel, not to the business function, to the control functions, to the board level committees. And your analysis should be complete. As I said, whenever I ask for the minutes of ALCO, or whenever I ask for the analysis from the middle office, then it should be quite comprehensive. There should be some projection. If I'm sitting with senior management of the commercial banks today, they must be able to talk about some projections, some stress tests. But no, we are not seeing that. And it is still a weak aspect. Risk profiles and ICAP, that is a very basic thing in pillar 2 that I'm emphasizing, why we move to our risk management thing. So internal capital adequacy assessment process. We have seen that BFIs are changing those norms also. Though you say that, just for an example, very basic example, you said in your ICAP that you'll be having 2% buffer in regulatory required capital. You spelled out in your ICAP. But when you have stress, now you are thinking that I cannot maintain that 2%, then you changed your ICAP. Now your buffer is 1%. So is it a good practice? So what is the meaning of ICAP then? What is the meaning of pillar 2? That is not the proper way. So we want risk functions to have some strengthening risk management practices, applying internal limits, strengthening the level of provisions and reserves, and improving internal controls. This is what we expect from control function. The other one is knowledge and competence. Uh, Again, the investment in HR, the investment in risk functions. Risk functions, audit functions should not be like punishment placement. I remember those days when we started with risk functions, and then most of the colleagues from BFIs were to tell me that, sir, it is something like punishment placement. I want to go to corporate banking. I want to have some business targets. But now I don't think it is the same for now, but still we want to see more on knowledge and competence, more on analysis, more on reports, more on research. Board level committees should oversee the risk function, not only to the regulatory norms that you have to have this number of meeting and only this stress testing agenda should be discussed on this and that committee. We want them to have some more effort on control aspects, on risk functions. We want them to explore international best practices. We want them to move ahead on control functions rather than waiting NRB to spell out certain words or certain phrase in the circular. Why not to follow some international best practices rather than waiting NRB to issue a circular? Supervisor assesses the quality of risk management process. This is the basic norm. We try to assess the risk management process and we want to assess your pillar 2 risk. So what buffer you want to maintain, what sort of extra thing you want to do internally. We all know it need not to be uniform. All of you have different practices, different norms, different culture in your bank. So it is not like that the same uniform thing will apply to all of you. Your portfolio, your strength, your experience, your nature of doing business, your model of business might be different. So it is not uniform for all. That's why we expect you to develop your own contingency plan, your own plan B, your own risk management policies. Internal processes rather than prescriptive requirements. We know it. For the risk functions, we don't want to go through the prescriptive requirements. Otherwise, we'll just change that circular number 5 and say that these are the mandatory thing, you need to do it, and this applies for all. No, it is not like that. You can have, and so that if you have read circular number 5 carefully, we have said that we are encouraging banks to go through the international best practices. We want them to have something new. We want them to have something more on it. Being watchful to communication vehicles. We want you to be watchful to our communication vehicles. By this, what I mean is we have issued financial stability report. We have issued bank supervision report. We have issued current macroeconomic indicators and all. So we want all these middle offices, all these analyses, all these policy making things to be watchful on those communication vehicles of the central bank or of the regulator. So how carefully you have read those things or how carefully you have gone through those things, I want to make you think more on that. And all material risk, it is not only credit risk, it is not only liquidity risk. You try to have management practices for all material risks. To close, this is my last slide. To close, I would like to emphasize more again on board's awareness, attitude, and commitment. As I have already mentioned to you, our risk management guideline expects to have a better risk culture in BFIs, and we want boards to take the lead. We want them to be aware, to have a proper risk attitude and proper commitment toward the risk management functions. Otherwise, as I have already showed you, that we are being much more short-sighted, only focusing on the numbers or the profit. Shift to risk culture from compliance-only culture. Sir, यो पनि लेखिदिनु पर्यो, sir, त्यो पनि लेखिदिनु पर्यो, sir, यो पनि clear हुनु पर्यो, त्यो पनि clear हुनु पर्यो. That is only compliance-only regime. So let's move ahead. Read the spirit, read between the lines. Sir, यो त पाइन्छ, यो त पाइँदैन, यो त हुन्छ, यो त हुँदैन. No, you have to be more aware, and you decide in your own as a managerial decision whether it is a prudent thing or not. So move toward risk culture, rather than focusing on compliance culture only. The other is independent and adequate. We want risk functions to be independent, free from the business targets. That's why I have already mentioned that in those earlier days, even in our risk management guideline, the earlier guideline, it was mentioned that chief credit officer is considered as chief risk officer. Those were the earlier days. But now, we want to have separation in those functions. We are saying that even those credit functions should be segregated. Like the person who is soliciting the business should not be doing the credit assessment. And the person who is doing credit assessment should not be deciding. The person should not be having some credit delegation, credit approving discretion. And the person who decides about the credit authority, he or she should not be having access to the system. He or she should not be posting the limits in the system. So see how we are segregating the credit functions also. So same thing applies to liquidity functions and all. Segregation of the duties, so that your risk function is quite independent from the business targets. You are not biased. If you are having that conflicting objectives, then you would get carried away. Should you focus more on business target, or you focus on control functions? So we want risk functions to be independent, and the final thing is adequate, commensurate with the size and nature of the business. This is it has already become something like cliche when we discuss about the Basel Accords and Basel principles. Everywhere you notice this phrase, commensurate with the nature and size of your business. As I've already said, all of you have different banks. All of you follow different culture, different norms. So have something adequate for your system. For example, in earlier days, we used to, still, it is so deep-rooted that we use the terminology CPG, Credit Policy Guide. And I ask immediately when I hear this terminology, excuse me, sir, it is your policy or guideline? Is it your credit policy or credit guideline? So we are so deep-rooted in those earlier days that the same word like credit policy, guideline, manual, whatever, it is same thing. No, policy is something else, guideline is something else, operating procedure is something else. You develop all these things so that you can have a complete and adequate control functions. So with this note, I'll end here to have some Q&A. If you have some questions, I'm happy to answer that. Thank you. Yes.
Senior management oversight always comes first. Can you elaborate it with the practical examples?
Okay. It is something like whenever we review the minutes of the bank, we see there much more discussion on the credit files, from 1 to 60 credit files, 1 to 80 or maybe more than hundreds also in some banks. So they are deciding about the credits, and they decide like the credit files presented by the management is approved or taken over or something like that. But are you discussing about the control functions? Did you discuss about interest rate risk analysis? Did you see those presentations? Did you see those analyses? And is your bank ready to take interest rate risk for this and that certain period? Because for now, a regulator has mandated that you have to take interest rate risk for a quarter for the credit side. And for the deposit, you can take it for 1 month only. So can we see these analyses in the board minute being reported? Can we see these limits? Are they talking about limits? Are they talking about ICAP? So these are the practical examples. We expect that. But they misinterpret in this way that, no, how can you give everything to us? I have faced this comment that I am here just only for meeting. I don't have any office in this bank. I'm here just for 1.5 hours. And how can I do all these things? How can you put me in the jail? So they commented like that, but still we expect them to talk more on control functions too. Because I have said that control functions and business functions merge in the board only. I hope that answers. Thank you.
Hello, sir. Just I would like to invest the moment as you are here. पछिल्लो समय चाहिँ कस्तो देखिन्छ भने
Can you use mic?
राष्ट्र ब्याङ्कबाट आएको सिलिङहरू we take them as a capacity and we have appetite in places. But nowadays what we are seeing is the appetite is going equal to the capacity. What is your view on this?
I have presented the whole view for the 1 hour because the banks are taking that as appetite, that as limit, that as tolerance limit, that's as the whatever the single number is, as you have said. But we want them to take it as a regulatory norm and have your own analysis. Pillar 2. I'll just answer in that way.
नमस्ते म विष्णुहरी कोइराला नेपाल एसबीआई बैंकबाट हजुरले इन्डिपेन्डेन्टको कुरा धेरैचोटि पनि आयो यसमा हैन अडिट डिपार्टमेन्ट रिस्क डिपार्टमेन्ट इन्डिपेन्डेन्ट हुनुपर्छ जब पोस्टिङ प्रमोसनै म्यानेजमेन्टबाट हुन्छ भने इन्टरनेसनल स्ट्यान्डर्डको चाहिँ इन्डिपेन्डेन्सी रेगुलेटरले किन नल्याउने म्यानेजमेन्टलाई नै छोडिदिने हो भने त इन्डिपेन्डेन्टको कुरो त सार्थक हुँदैन
Okay. To some extent, त्यो पनि एउटा excuse हो जस्तो लाग्छ मलाई. But as you have said, some sort of promotion or performance appraisal त्यसमा पनि हामीले छुट्याएको छौँ हैन त्यो हेडको कसले गर्ने तलको कसले गर्ने भनेर. So it's more professional decisions पनि हो जस्तो लाग्छ. मेरो सरुवा वा मेरो promotion त CEO ले नै गर्ने हो, so I need to be more focused toward business. Completely right पनि हैन यो. अब यसमा पनि फेरि रेगुलेटरले नै फेरि कुनै सल्युसन दिनुपर्छ जस्तो पनि मलाई लाग्दैन. So it's yours. How prudent is your senior management? How professional is your senior management and board? It depends on that.
Yeah, hello. Hi, Kiran sir. It's always great to hear you talk. I'm Ranjit, NMB Bank. My one question, when we are talking about risk culture, as Kiran sir pointed out, that banks needs to be more prudent and start asking questions: can we do it or shall we do it? And not to expect every regulatory provision in black and white and interpret on your own, being prudent. So in that context, when there is gray area on how to interpret the regulatory provisions, banks do interpret in a way that is more appropriate to the banks at any particular point in time, right? So in that context, some banks may be more prudent, some banks may be less prudent, depending upon the need of an hour. So in that context, how Rashtra Bank should, would be considering carrot and stick to, to motivate the prudent banks and also to, penalize not so prudent bank. I just wanted to add that.
Thank you, Ranjit, and you have your own answer. I know that there is always this discussion that what if the other bank is doing non-compliances and they are not getting any penalties or punishments from the regulation or regulator, and I'm just following the circular, I'm being very prudent bank and I'm getting nothing from the regulator. This is an ongoing discussion. Personally, I feel that there should be some differences. The regulators should pass on the message to the non-complying banks that there are supervisory actions against you. We are going to take this and that supervisory action against you. That should be clear. That should be clear. Personally, I feel that. But regulator has some other limitations also. We need to have, we need to look after all the entire system. We need to look after the herd behavior. We need to look after the systemic crisis also. So just a plain and simple statement that this bank is doing non-compliance, so take action against it. This can be a very light statement. But we are being watchful. We take certain actions, which is right and correct. And personally, I agree with you that there should be some differences. Thank you.
Thank you, sir. So it was a very nice presentation
Thank
from
you,
the
thank you.
regulator's perspective.
Thank you
Thank
all.
you so much for your time and presentation, sir. Just a minute, sir. Just a minute. So we have a small token of appreciation to Kiran, sir. And I would like to request Suman Sharma, sir, the CEO of Sunrise Bank Limited, to do the honor. Thank you, sir. Thank you, sir. So with this, we come to the presentation session for today's program. And now we have a tea break. We'll break for 15 minutes. The tea is ready out there at the breakout area. Thank you.